Welcome back to the deep dive. Today we are undertaking a pretty critical mission.
I think so.
We're trying to synthesize three massive converging forces that are, well, aggressively shaping the entire digital asset landscape here in early 2026.
Right. And our source material for today really paints a picture where the focus has decisively shifted.
How so?
Well, volatility is always there. It's a constant in crypto.
Yeah.
But the fundamental conversation now is about structure, not just speculation.
So we're connecting the dots.
Exactly. Between political movements in Washington and Brussels, the tidal wave of institutional capital, and the persistent pulse of retail sentiment.
And especially where that retail side intersects with what new compliance demands.
That's it.
Yeah.
It all boils down to maturity.
Yeah.
The industry is moving past its wild frontier phase. The key drivers for 2026 aren't new meme coins.
No.
It's defined regulatory frameworks, proven business models, and, enterprise-level infrastructure.
Okay, let's unpack that structural shift then, starting right here in the U.S. Congress. For years, the industry has just been begging for an answer. Who is in charge of this space?
It's been a total turf war, primarily between the Securities and Exchange Commission, the SEC, and the Commodities Futures Trading Commission, or CFTC.
And the new proposed crypto bill, the so-called Clarity Act, that's supposed to fix this.
That's the goal, resolving that jurisdictional ambiguity. And the framework, as it stands, leans very heavily toward the CFTC.
And why is that CFTC designation so important to everyone in the industry?
Because it's just a lighter, more fit-for-purpose regulatory touch for a lot of these digital assets.
So if most tokens are seen as commodities?
Then they avoid the decades-old, often suffocating compliance rules that come with being a security under the SEC. It changes the entire calculus for how projects launch.
And we're seeing other moves too, right, to protect the builders?
We are. Senator Lummis's move to shield Bitcoin developers from being classified as money transmitters, that removes a huge source of legal worry.
And hearings on that are expected this week, I believe?
That's right. And this legislative push, it has context on the legal front. You just have to look at Ripple.
Right. They successfully argued years ago that XRP should be a commodity, depending on how it was sold.
But they didn't stop there. They're still actively pushing, asking the SEC to treat tokens separately from securities transactions. They want regulation that's, tailored for digital assets.
Not just shoehorned into laws from the 1930s.
Exactly. But this isn't just a U.S. story. Things are shifting globally. Take Dubai, for instance.
The DFSA. They just removed their list of recognized tokens.
They did.
Which, on the surface, that sounds like a step backward, right? Less clarity.
It sounds like it.
Yeah.
But it's actually a move toward greater professional accountability.
What do you mean?
The DFSA is basically saying to the licensed firms, it's on you now. The responsibility for evaluating a token's suitability is entirely on them.
So the burden shifts from the regulator to the business.
Precisely.
Yeah.
Meanwhile, you have the EU with its own massive deadlines, especially around central bank digital currencies, CBDCs.
I keep hearing 2026 called the inflection point.
It absolutely is.
Good
And it's
count.
running on two speeds. The wholesale CBDC projects, the ones for banks, are moving ahead fast. The ECB's Project Pontus should go live in the second half of 26.
And that's for the big players, for settling tokenized assets. What about the retail side, the digital euro for you and me?
Well, the preparation phase for that is complete. The design is meant to complement cash, not replace it. But
There's a but.
there's a big but. It still needs a key parliamentary vote in the first half of this year.
Yep.
And our sources say that remains a highly volatile political point.
So while Washington and Brussels are grappling with all this clarity, the market is voting with its capital.
It always does.
We see Bitcoin consolidating above $91,000. And that's while traditional safe havens like gold are hitting, what, $4,600 an ounce?
That continued position above the 200-day moving average keeps that digital gold comparison alive, even with the higher volatility.
But this consolidation phase, it feels like the market is just holding its breath right at that $91,000 mark.
It is. It's been struggling to break the resistance between, say, 91,600 and 93,500.
So if all this institutional money is flowing in, why aren't we breaking out towards 100,000 already?
That's where the psychology gets really interesting. Glassnode's sell-side risk ratio has dropped sharply to its lower band.
And that tells us what exactly?
That ratio tells you when long-term holders are aggressively cashing out. The fact that it's low suggests they are not rushing to sell at this level.
So the sideways movement isn't from sell pressure. It's just quiet accumulation, a constructive consolidation.
Exactly. It suggests a calm, long-term outlook. And this lines up perfectly with what the Binance CEO, Richard Tang, said,
Which was?
that the market has moved beyond its retail trader infancy because of a massive influx of institutional capital over the last couple of years.
And you see that conviction with a company like Strategy. I mean, they just announced another huge purchase.
Colossal. $1.25 billion worth of BTC, bought right around that $91,000 level.
Which brings their total holdings to over 687,000 BTC. That's more than $51 billion.
And it's not just Bitcoin. Ethereum ETFs saw $168 million in net inflows just last week, so investors are adding diversified exposure.
Which is a stark contrast to the M&A market, which just exploded.
Absolutely skyrocketed.
Yeah.
Q3 of 2025 set a new record. Over $10 billion across 95 deals.
100% increase from the previous quarter.
Yep. And a lot of that surge was driven by a complex financial structure, the DEET reverse merger.
Okay, can you simplify what a DEET, a digital asset treasury reverse merger, actually is for us?
Sure. Think of it this way. Instead of buying a private company, a crypto firm is buying a public shell corporation that already holds a huge treasury of, say, Bitcoin or Ethereum.
And why do that?
It's a way to consolidate, clean up the corporate structure of the industry, and raise capital now that valuations have stabilized a bit. These deals made up $6.2 billion of that total.
And beyond these financial maneuvers, what's the strategic play? What are they buying?
It's all about the payment use case. We saw Ripple buy Rail, a B2B stablecoin specialist. Solomon Holdings bought Alloyx for its stablecoin payment tech.
So building real-world payment rails.
Exactly.
Now let's talk about the biggest, most shocking transaction. The outlier that tells us something really fundamental.
The acquisition of Core Scientific, a major Bitcoin miner, by CoreWeave, an AI cloud provider.
For a massive $7.8 billion.
Right. And the key takeaway here is not about crypto. It's about infrastructure.
The physical layer, the power capacity, the data centers, that's now the most valuable commodity, even more than the mining itself.
Absolutely. This wasn't a crypto play. It was driven by CoreWeave's desperate need for power and data centers to serve its AI clients. Core Scientific is now shifting away from Bitcoin mining.
Because AI is more profitable.
And hungrier for power. The competition for power is now the defining feature of the digital economy.
Wow. Okay, so that institutional push for power sets the framework. But what about the individual investor, the retail player? A lot of that conversation starts on Reddit.
It does. Reddit matters because it's a huge sentiment monitor. Over 100 million daily active users. The voting system acts like a decentralized peer review, filtering out noise.
And you can search the history to see how sentiment on a coin has changed over time.
Exactly. People go to subreddits like our cryptocurrency for news, our Bitcoin for deep tech, and Roltcoin for those emerging low-cap opportunities.
So if we look at the hottest pre-sales being talked about, what narratives are driving that enthusiasm?
There are two distinct ones. First is utility, specifically how to make Bitcoin better. And that brings us to Bitcoin Hyper, or HYPR.
A layer 2 solution for Bitcoin. What does it actually promise to do?
It's designed to solve scalability and speed on the Bitcoin network. It uses zero-knowledge proofs and Solana's virtual machine to do it.
In simple terms for you at home.
It means they're creating a fast, powerful sidechain that can handle complex smart contracts without messing with Bitcoin's core security.
Okay, so that's all about utility. On the complete opposite end, you have a project like BMC.
BMIC is strictly about defense. It's a security-focused wallet built on a post-quantum cryptography stack.
That sounds like some serious jargon. What does post-quantum security mean for my wallet?
Think of it this way. Scientists expect quantum computers will eventually break today's encryption. They could steal your assets just by finding your public key.
And BMC stops that.
It's designed to hide your public key on-chain. It's like a digital lock that even future supercomputers can't pick. A pure bet against the future of math.
So we go from high utility to existential security, which means we now have to shift from these exciting prospects to the unavoidable reality that follows.
Tax compliance.
Tax compliance.
This is where the fun stops and the diligence begins. The core rule, and we have to reiterate this, the IRS classifies crypto as property. Any profit is subject to capital gains tax.
So lay out the most critical taxable event, the one that always surprises new investors.
It's using crypto for purchases. It's not just selling for cash. If you use crypto to buy goods or services, that is a taxable event.
Give us a practical example.
Okay, so you bought Bitcoin for $4,000. 6 months later, You use that same crypto to buy a $5,000 laptop.
Okay.
At that moment, you realized a $1,000 taxable gain. That's reportable income. It's that simple.
And separately, earning crypto from staking or airdrops is taxed as ordinary income when you receive it.
At its fair market value, yes. And we can't forget timing. The holding period changes everything.
Right.
Short-term gains, assets held for less than a year, are taxed at your high ordinary income rate, up to 37%.
But if you're patient,
If you hold for more than a year, it falls under the lower long-term capital gains rates, 0, 15, or 20%. The tax code literally rewards patience.
and 2026 brings some major compliance shifts that make transparency unavoidable.
Transparency is the new mandate. Starting in 2025, digital asset brokers exchanges, custodial wallets, they have to report your activity on the new Form 1099-DA.
Meaning the IRS will have granular, automated data on every single transaction,
The era of the honor system is definitively over. And then there's the wash sale rule,
which would completely change how investors handle losses.
fundamentally. If applied to crypto, it would prevent you from taking a tax deduction if you sell an asset at a loss and then buy the same or a substantially identical asset within 30 days.
So no more selling Bitcoin on a Monday to claim a loss and then buying it right back on Tuesday.
Exactly. You'd have to wait 30 days or buy a completely different asset. It forces a total rethink of year-end tax strategy.
We've covered a massive loop today, from the halls of Congress down to your personal crypto wallet.
It's a real convergence point. Regulation is moving toward clarity with the Clarity Act and CBDC deadlines. Institutional capital is flowing in massively.
As we saw with strategies buys and the record M&A.
And retail, while still chasing high-potential pre-sales, is now fully under the microscope of stricter compliance, thanks to that new 1099-DA form.
So that's the ecosystem in January 2026. You need to watch regulation for stability and institutional flows for momentum. But always, always be diligent.
Especially with those highly speculative assets on Reddit. And never underestimate the scrutiny from tax authorities. It is unavoidable now.
So this deep dive, it showed us these two connected but opposing narratives.
On one hand, you have that massive $7.8 billion deal where an AI company bought a Bitcoin miner purely for its infrastructure, for its power.
And on the other hand, the emergence of security-focused tokens like BMIC, which are designed to withstand a future threat from quantum computing.
Exactly.
So here's the final provocative thought for you to consider. We've established that the competition for physical power is driving massive acquisitions.
And we know that AI needs vast amounts of that power, while quantum computing poses this existential security threat.
So, will the convergence of AI and quantum computing ultimately force crypto assets to re-engineer their fundamental foundations just to survive?
To survive the competition for power and the threat of new mathematics, rather than just focusing on current utility or speed.
Something to mull over until our next deep dive.